Hello, everyone. Good morning, good afternoon, or good evening, depending on where you are joining us from the world today. I'm in noisy New York City, as you can tell by the background noise. I apologize for that. We hope to bring you a quality webinar nonetheless. Today's presentation is entitled Asset Allocation, Where, When, and Why, presented by Professor Henrik Lumholdt of IE Business School in collaboration with Ivy Exec. My name is Niatsu Ben Cientrel. I'm the Senior Content Manager here at Ivy Exec. I'll be helping to moderate today's session. Before we begin, I do want to review a couple of very brief housekeeping items for the audience. First, all attendees are currently in listen-only mode. However, we do encourage participation in the session by asking questions to the presenter. You can do so using the GoToWebinar control panel, and there's a chat box, and you'll find this control panel on either the left or right-hand side of your screen. We do encourage questions, and there will be a formal Q&A session in the final 15 minutes or so of the presentation. The final point is that we are recording today's session, and you can look forward to receiving a copy of the recording via email in a few business days. And now I'd like to introduce you to today's presenter, Professor Henrik Lumholdt. Henrik has been an adjunct professor of economics and finance at IE Business School since 2001, and also the founding partner of Inside Economics, a top-down financial consultancy. He was until recently the chief investment strategist for Spain's largest asset management company, BBVA AM, and previous positions include chief economist for Bank of America Spain and head of fixed income research at FG/Merrill Lynch. Outside of IE, Henrik is a member of the Work Group for International Economics of Spain's think tank, El Real Instituto Elcano. He also holds a Bachelor of Science and a Master's of Science in Economics from the Copenhagen School of Economics. And with that, it's my pleasure to turn things over to Henrik for the remainder of the presentation. Henrik?
Thank you so much, Nai. A very warm welcome. Let me see if I can go forward here. Very warm welcome to everyone. We're going to go through some key topics of asset allocation. But let me just present my ideas, the central ideas to this presentation before we even get started. The first one is that there is really no passive or neutral alternative when we talk about asset allocation. And that is worth highlighting because we do have passive alternatives in pretty much all other types of investment. There's a big difference in the drivers from the strategic to the tactical level, and it's critical that we understand which driver belongs where. And finally, and that's the key theme, the strategy and the tactics are complements. They are not alternatives. We have to use both levels to be successful in asset allocation. I've included a little bit of a commercial slot here, if you don't mind. If we'll try to do a general presentation without too many technical details, but if you're interested in digging deeper into some of the more specifics, of course, there's so much you can talk about in this subject. Perhaps you want to check out my new book on asset allocation. It's called Strategic and Tactical Asset Allocation, an Integrated Approach, which is the key theme of what we're going to talk about today as well. This is the structure of the presentation. First, I'm going to make some comments on why we cannot really make asset allocation passive. Secondly, I'm going to talk about the strategic asset allocation, the SAA, of the challenges of forecasting returns and the challenges of optimizing the portfolio. After that, we'll go straight into a framework for tactical asset allocation, which I call the four-phase framework. And we'll round off with a discussion of where we are now. And at the end of the presentation, I'll make some conclusions. You're welcome to ask questions as I go through the presentation, but it's probably better if you do it at the end, frankly, because it gets a bit more orderly then. But we'll try to do it as it goes by. So back to the question, can asset allocation be made passive? What is this all about? Well, when you think about it, if you had a fund manager managing a fund with, for example, stocks, you'd have a benchmark for that fund. The benchmark would typically be an index. So if you manage a fund on US stocks, maybe the benchmark is the S&P 500. So you could invest directly in that stock, in that index. Nowadays, of course, we have index funds, and we've had that for a while, and we have ETFs. So there is a completely passive alternative In which sense is it passive? Well, it's passive in the sense that we don't actually make any decisions on the individual stocks in the portfolio if we use an index. It's the same as the index. So we don't actually express any decision. Now let's try to go to the asset allocation level and see how this logic applies. I already mentioned we distinguish between strategic asset allocation, which typically has a time horizon upwards of 10 years, and tactical asset allocation, which can span, say, over 3 to 18 months. This is a little bit individual, so it's hard to make a very hard definition here. The practice in the industry is to compare the performance of our tactical asset allocation to the strategic asset allocation. So the strategic asset allocation, in a sense, is the benchmark. So if we say, well, we have a certain weight of each asset class in the strategic asset allocation, well, if we varied from that in the tactical asset allocation, we can measure afterwards whether this was a good idea. Or put differently, did the TAA portfolio outperform the strategic asset allocation? So far, that's pretty straightforward. But when you think a little bit about it, the SAA is not the regular benchmark that we normally use when we talk about an individual asset class. It's not free of decision, because where do those initial weights come from? We don't actually have anything we can take out there in the world, which is objective. We've decided what these weights should be in the SAA. So the SAA is not free of decision, and it's not passive. It doesn't constitute a benchmark in the correct way of the correct meaning of the word. In fact, the SAA is arguably the most important decision we make, because this is the level of absolute risk in our portfolio. So what does it mean if we do TAA? Well, that's a relative risk. It's relative to the SAA. So if you think about it like that, the SAA should have a benchmark. But we don't have a benchmark for the SAA. Well, unless you want to use the whole capital market, which is a little bit stretched, or some future liabilities, then it gets a little bit more tangible. But the key point here is there is really no way around taking decisions. The SAA is a decision. The TAA is a decision. We don't really have a passive alternative in asset allocation. The reason I mention this is that you may know this very well. There's been a flow of funds going into passive investment vehicles, ETFs being a case in point. A lot of people think that stock picking, or rather security selection, has not been worth it, and that it's better to buy one of these passive alternatives at a lower price. But the key point here is we cannot really do that when it comes to asset allocation. We are forced to making decisions. So you might say, well, that's fine, but I don't like short-term decisions. TAA is a fool's game, as I've written in the text. In the sense, well, forecasting in the long run is much easier, is it not? Well, I don't quite agree with that. And I'm going to show you some of the challenges of going for the SAA alone to illustrate the uncertainties that are inherent in that. So this is my way of understanding the relationship between the strategic asset allocation and the tactical asset allocation. So since we're here in Spain, I'm in Spain, I'm imagining that we want to go to the Americas. In this case, it's South America. So we're taking off from Cadiz in the south of Spain, a wonderful place, by the way. So we have a route to go to our destiny, to get to our destiny. That's the strategic asset allocation. But after we've taken off from Cadiz, it turns out that the wind has changed, maybe the currents has changed, and we have to accept that we're going to deviate from the route. This is the tactical asset allocation. And of course, if we want to get to our destiny, we have to get back on the route again. The same thing applies to asset allocation. TAA must necessarily be a temporary deviation from the strategic asset allocation. That's the crucial idea. So let's get deeper into forecasting returns and thinking about how we can optimize the portfolio. So first subject is, how do we choose a time horizon? So in principle, if we have a long-term approach, we should be able to ignore what is called the business cycles, the ups and downs in the economy. And we can arguably base our forecast on the idea of a mean reversion of valuations. But it's not that simple, because there is necessarily a trade-off here. If we have a very long time horizon, say 20 years, 30 years, our visibility gets limited. Why does it do that? Well, scenarios could change dramatically. Maybe we'll have a new situation of extremes. A lot of things kind of happen over this time span, and it gets very difficult to predict anything. But on the other hand, if we shorten the time horizon, the business cycle kicks in again. We'll get back to the business cycle later in the speech. Okay, so a lot of market participants use a 10-year horizon because it's a reasonable in between. Let's see how that works. We're going to look at three main asset classes: stocks, mainly US stocks, but it doesn't really matter whether it's US stocks or any other stocks. We're going to talk about government bonds and a few comments on corporate bonds. And we're going to look at two different approaches to forecasting returns, using the historical information and using forward-looking models. Let's start with the historical information. So it's well known that stocks outperform pretty much anything in the long run. This is an illustration here from the book by Jeremy Siegel, which is well known, Stocks for the Long Run. It's a good title because it is true that stocks outperform in the long run. But the question is how long that long run has to be. So this is an extremely long run. It's about 2 centuries long. Stocks outperform government bonds, T-bills, and gold. Zooming in on a somewhat shorter period, we can use the material from the so-called yearbook that Ibbotson and his associates create every year. It's updated every year. This gives a slightly more detailed information. If you look at the first column here, you can see that small caps outperform large caps, government bonds outperform corporate bonds outperform government bonds, even though it's not by that much, and longer dated bonds outperform shorter dated bonds. But crucially, stocks outperform bonds hands down. Now go to a 10-year time horizon, the time horizon we chose. What do we see? Well, it gets a lot more blurred. It's very clear that returns are time dependent, both if we look at them in real terms, in other words, adjusting for inflation, and if you look at them in nominal terms. We cannot really use the historical record as any guide because it pretty much could be any one of these, any point on these two lines. Then there's the issue of macro fundamentals, macroeconomic fundamentals. When you look into the future and you consider stock market returns, it's natural to think that the growth in the economy should matter. But the truth is, research has found that that's not necessarily so. Or maybe it's hidden. I'm not going to go into the reasons why this might be, but the studies have found that the correlation between economic growth and stock market returns is sometimes even negative. And when it's not negative, it's very weak. And when you think about it, we actually have a recent example of this. 2009, the US economy gets out of the recession and the stock market starts recovering. And the recovery gets stronger on the way. The US economy hasn't actually been roaring along until very recently, when we had a much higher growth rate. But most of this period, it was relatively modest growth. And yet the stock market has seen an amazing recovery. So the relationship between the two doesn't seem to be very obvious. And this is important. So can we use a forward-looking model? Well, I'm going to bore you a little bit with some sort of textbook stuff, but it's a good illustration of what I want to talk about, the discount, the dividend discount model. You could think about stocks as simply a vehicle that gives you a dividend every year, and then when you finish the investment, you get the price of the stock when you sell it. But of course, that price, we could express that as a series of dividends. And since stocks don't mature like bonds, it must be sort of an infinite stream of dividends that we're looking at. We need to know a little bit more about the dividends. What happens to the dividends? Well, we can assume that there's a certain growth rate. So that brings us to the next model, the Gordon growth model. We have a dividend every year, and it grows by a certain factor, which is G. Don't worry about the formulas. It's not the key point here. We're going to try to boil this down to something essential. This expression you can see here can be reduced to something much more simple. The price of the stock is equal to the dividend divided by the discount rate minus the growth in the dividend. We can rearrange that and say, okay, then we have the dividend divided by the price. That's what we call the dividend yield, and the growth in the dividend. So it actually ends up being pretty simple. So another way of thinking about this is that we have an income component, which is the dividend yield, and we have a capital gain component, which comes from the growth in dividends. So we need to forecast for both of these components. So what's the historical record? Here's the dividend yield. We've had a relatively stable dividend yield the past 20 years, but it shifted lower from the previous period. And some researchers say that this is probably down to buybacks, because buybacks are more tax efficient. But if you look at a longer period of time, there isn't really any very persistent trend in buybacks. So we cannot really factor that in very well into our forecast. And then there's the growth in the dividend. What we're seeing here is a rolling 10-year average and a rolling 30-year, annualized nominal growth in the dividends. And as you can see, the two averages actually pretty much coincide now at a rate of growth around 6%. So can we trust the 6% as a reasonable forecast? Well, most analysts actually, or strategists, think that that is too high going forward. Here's a slightly different model, but ultimately it is very closely related to the dividend model at the end of the day. And it was created by the founder of Vanguard, John Bogle, who's a distinguished financier. Bogle says, well, let's decompose the equity return into an investment return and into a speculative return. The investment return is the dividend growth, or the dividend yield, and the growth in earnings per share. And the speculative return is the change in the price-earnings ratio. Now, research done by Mr. Bogle and a gentleman called Nolan shows that that model works quite well, and indeed that the price-earnings component is not that important if you have a very long period, very long time horizon. The problem is that that's not necessarily true when you have a shorter time horizon, such as our 10-year period. So that brings us to the next subject, namely valuations. How do we deal with that? What you see here in this chart is nominal returns, again on the S&P 500, rolling nominal returns. That's the bold line. And below that is the change in the price-earnings ratios, again over a 10-year period. When you think about it, the difference between these two must be the contribution from the dividend yield and the change in the earnings. But what stands out as well is that low stock market returns tend to coincide with declines in the price-earnings ratio, and high stock market returns tend to coincide with multiple expansions. What does that suggest? That valuations are very important to our final result. So here's a study of that, which I think is interesting. It's Clifford Asness from AQR, who's written a lot of interesting things. And what he does is he uses the so-called cyclical adjusted PA. This was invented by Professor Schiller of Yale. And the idea is that since the economic cycle can sometimes impact earnings quite dramatically, we'd like to eliminate that from the calculation. So it's cyclically adjusted, which is a more sort of stable expression of the price earnings. Now, what do we see here? Well, Mr. Asness's analysis says, let me take different buckets of the CAPE, CAPI, however you want to pronounce it, and let's see what happens in the subsequent 10 years. Now, it's true that when you look at it, you have a worst case and a best case scenario for the subsequent 10 years. There is quite a range, a relatively wide range between the worst and the best cases. But it's also true, if you look at the average, that a high starting point for the CAPE does imply a lower subsequent 10-year return. And on the other hand, the opposite applies as well. Another observation is that when the CAPE is at extremes, meaning it's very high or very low, the standard deviation of these results is lower. And that means that it's more reliable. So this is a good illustration of the importance of valuations. But this prompts a new question. Right now, the market's not exactly cheap. I'll get back to where we are right now. But could that be due in part to low interest rates? See, the reason for asking that is that there is a practice in the market of comparing the earnings yield on stocks, which is the reverse of the price earnings ratio, to the yield on a 10-year bond. So if the earnings yield is higher than the yield on the bonds, equities are cheap. If it's lower, equities are expensive. If you think very deeply about this, you can criticize that model because it compares something which is really in real terms, namely the earnings yield, with a measure in nominal terms, which is the bond yield. But nonetheless, if you look at it, at least in recent years, and that's quite a long period, the models actually perform quite well. So that prompts the question, are higher rates a threat to stocks because they impact valuations? What I'll say so far is there's certainly a headwind, but let's see what else we can say about the present scenario. So applying the Bogle model, how could we do this? Well, we could say, okay, we accept that the dividend yield is going to stay relatively unchanged around its current level of 2%. We believe that we'll have lower economic growth, so that points to lower growth in earnings. So we could target, say, 4% rather than the 6% for the next 10 years. And finally, valuations. The CAPE is currently at 31.5 according to Robert Shiller's database. That's below the 40, which was the maximum we saw in early 2000, but it's much higher than the historical average of 17. So we might say, okay, we're going to factor in a mean reversion of that ratio. Maybe something corresponding to a negative valuation effect of 1% per year. If we sum this up, we get a return in the stock market of 5% per year over the next 10 years. Is that a robust forecast? Well, we can question, frankly, all of the assumptions that we're making. And the most critical one is probably the mean reversion. It could be smaller or larger. Should we use the Bogle model? I think absolutely we should. I think it's an excellent model. It's a good, solid framework, but we have to be realistic about our ability to do this with any certainty. Bond markets. I'm just going to look at one relatively simple way of understanding the bond market, which I think is, from a practical level, very useful. Forward rates. What are they all about? Well, we can take a 3-year bond as an illustration and compare that with a 1-year bond. So the 3-year bond in this example yields 5%, and the 1-year bond yields 3%. So we could buy the 3-year bond if we had a 3-year time horizon and hold it to maturity. Or we could buy a 1-year bond and roll it over, meaning reinvesting, after 1 year and after 2 years. These two alternatives should give us the same result. If we don't believe that is the case, we should prefer one of them. So if the 1-year bond rolled over twice gives us a lower return than the 3-year bond, why even buy the 3-year bond? And vice versa, of course. It could be that the 3-year bond gives us a lower expected return than the other one. We are ignoring one thing, namely the so-called term premium. The tricky thing here is you would expect the term premium to be positive. The term premium is the compensation that investors demand for accepting the risk on longer dated bonds over shorter dated bonds. Longer dated bonds are more volatile. They have a higher duration. And that it makes sense to believe that there should be a premium over and above what those forward rates imply. But intriguingly, if you look at the chart, we've actually seen more periods of a negative term premium in recent years. Perhaps there's a preference for long-dated bonds, and perhaps the unconventional policies by the Fed has created this situation, but we don't really know. Going back to the forward rates, we have information on this because the market prices forward rates well into the future. I'm only showing you here 3 months euro dollars. That goes actually much further into the future. And then, of course, we have futures on the federal funds, the Fed funds. If you look at the Fed funds, the market is predicting that we will reach a top slightly below 3%, and that's pretty much what the Fed is projecting. So we just lean back and say, okay, that's cool. Well, no, we shouldn't. We should think whether we agree with this. Is that high enough or is it too high? What is our thinking? What if it's not high enough? Well, it might not be high enough. The Fed funds rate may have to go higher than slightly below 3% if we get an increase in inflation. And the term premium, of course, might become normal again, so to speak, and become positive. If you sum up those two things, then the yields on longer dated government bonds will have to rise above the level they're at the moment. So right now, I think the last time I checked, a 10-year bond yielded 3.15%. So maybe that has to go up to 3.5. If that's true, even though we're looking at a 10-year time horizon, we will end up with a lower projected return than what the bond is actually telling us in terms of its yield to maturity. See, this is an example of how the short-term scenario, which is where we are in the cycle right now, kicks in to the long-term view. Finally, just a comment on the credit market. Government bonds don't have a default risk, in principle at least, but corporate bonds normally have a credit risk, to put it differently. Now, can we just use the credit premium on the corporate bond? Well, no. Research shows that that's actually not true. If you look at the way bonds actually performed, corporate bonds, they've only outperformed treasury bonds by something like 20 to 50 basis points. But the spread indicated an excess return of more than 100 basis points. There are serious reasons for this, but I'm not going to go into that. I directed you to this excellent book by Antti Ilman and another professional from AQR. It's called Expected Returns. Now some comments on optimizing the portfolio. You may be familiar with portfolio theory, Harry Markovich, William Sharpe, and all that. What is it all about? Well, the key point here, the key theme is diversification. And that's very close to the heart of asset allocation. When you think about it, the whole idea of emphasizing asset allocation really is that we get much more risk diversification between the asset classes than we do between individual securities. But portfolio theory tries to optimize the portfolio, and that makes sense. We should have the right composition based on expected returns, expected volatility, and correlations. But we get into complications. The portfolio theory is based on assumptions which are not met in a lot of the periods we can look at. First one, normal distribution of returns, the bell-shaped curve. I've illustrated a so-called leptokurtic curve, which you can think of as one that has very fat tails. The normal distribution tends to overestimate the risk. One example is, and the calculation is that the declines, we've had declines 8 times of more than 20% since the mid-1920s. According to the theory of, if we had followed a normal distribution, that would have happened 1 to 2 times. Correlations are constant. That's another assumption here. It turns out that equity returns are much more correlated when we have a bear market than when we have a bull market. And that happens in the international markets as well. So we get less diversification exactly when we need it, namely during the bear market. So put differently, estimates of correlations which are static overstate the benefits of diversification. Finally, which period do we use for this input? We have to estimate risk, return, and correlations. We don't really know. There is no clear answer to this because most of this input is time varying. If we take a short period, we may end up favoring assets which have recently done well in terms of returns. They've had low correlations with the rest and a low volatility. But if we use a long data period, we might overlook periods of market stress, which is relevant information. So there's a dilemma here. So that brings me to the TAA. We said that long-term economic growth and long-term equity returns are not clearly related. See, when we turn to the shorter term, they actually do become more related, or put more specifically, the business cycle becomes very relevant to performance. Here's an illustration of the classical way of looking at business cycles. Expansion, the economy expands, meaning the GDP grows, GDP peaks, GDP contracts. Another way of saying that is that we go into a recession, even though that's not the exact definition of it, and we bottom out. There's a trough in the cycle. The average cycle lasts about 6 years, and the longest expansion that we've seen is about 10 years. So the current scenario is a candidate for breaking that, for beating that record. So that's very interesting, but does it actually give us any guideline? Not so much. It doesn't really help us to know how long the expansion has lasted. So that brings me to the next concept, which is the output gap. The output gap is a useful metric in practical asset allocation, not just for economists working for the government. We define it as the difference between actual and potential GDP. Potential GDP is what the GDP would be if we had an output which implies a full but not excessive use of our factors of production. Sounds a bit theoretical, but the idea here is that it's a production point of view. How much will the economy produce if it's using its resources fully, but without going too far? Now, the output gap shows us the relationship between what GDP actually is at the moment and where it could be. So as we go through a cycle, we go from utilization of capacity to overutilization of capacity, and then we go back again. So in terms of the output gap, that means we go from a negative output gap to a positive output gap and back to a negative output gap again. If you look at the recent years, the US economy has grown by more than its potential GDP. Actual GDP has grown by more than potential GDP. When that happens, a negative output gap will narrow, will decrease. And now we're close to a situation in which there is no, or we are probably in a situation in which there is no negative output gap. In fact, there probably might be a slightly positive one. So that actually allows us to divide the economic cycle into 4 phases. Phase 1, we have a negative and decreasing output gap. It's decreasing because we're outperforming the economy. The actual GDP is growing by a higher clip than potential GDP. We can continue this. If we continue at the high growth rate, we have a positive and increasing output gap. The economy will then peak at some point, and we have a positive output gap, but it would now be decreasing. That's a phase 3. And finally, at phase 4, the economy continues to underperform its potential, and we get a negative and increasing output gap. Is that interesting for asset class returns? Yes, is the answer. Let's see how they do in each of these phases. So to recapitulate, in phase 1, the output gap is negative, but it's narrowing. It's becoming smaller. Corporate margins typically expand, and earnings growth picks up. We don't really see inflationary pressures, and the simple reason for that, of course, is that there is plenty of capacity until we've closed that negative output gap. And that also means that the Fed, or whoever is the central bank, doesn't need to tighten monetary policy. So when you think about it, you have a combination of 2 things: high growth, but low inflation. Stocks typically like that. It is a bit of a sweet spot for stocks, and it explains part of what's been happening in recent years. Bonds are very dependent on rates, but if they're falling, they're still doing okay. Commodities do well when rates are falling, not so well when they're rising. The key point here is that stocks do well. Let's look at the next phase. we continue to grow at a higher clip than what the potential rate is of the economy. So because of that, we're creating a positive output gap. That, of course, it means that we've now exhausted all the resources in the economy, and there'll begin to be shortages in the production. Maybe we can't get workers. Maybe the fixed installations of equipment, machinery, what have you, starts to be in scarce supply. And that implies that inflation at some point will pick up. It typically does throughout this phase. So stocks now have a combination of two factors. Earnings are still strong, but we are getting higher rates, typically because the central bank will start taking steps to control inflation. And that typically implies lower multiples. Bonds typically underperform cash, except when rates are falling, which is not the typical scenario here. And finally, commodities do well. Indeed, commodities are often part of the inflation problem in this phase. Phase 3. We've now peaked and the economy starts slowing. So earnings growth starts slowing at some point, but inflationary pressures haven't disappeared. See, this is the key point about the relationship between the growth rate and inflation. Inflation often lags the growth scenario. So now we have the opposite of what we had in phase 1. We have a slowing economy, slowing in earnings, but inflation hasn't disappeared. So the central bank oftentimes cannot start easing. So we have relatively high rates. So that means we have earnings slowing and multiples contracting, the worst case for stocks. Bonds will do well when rates eventually fall. If the central bank is holding back for a while, they'll take some time, but then they will eventually do well. And commodities tend to do well, especially when rates are falling. Commodities are sort of a sign of late cycle inflation here in phase 3. And then there's phase 4, just to round off all the phases. Now, we've eliminated the positive output gap because we were growing at a low rate in phase 3, but we continue to grow at a low rate. So we now create a negative output gap again. So earnings growth will slow and eventually maybe even become negative, but inflationary pressures will now start disappearing. Will start abating. So the central bank can ease policy. So that gives us a combination of things. We typically have a positive return on stocks, but it's normally not very high. But there is an intriguing thing about phase 4. At some point in this phase, we typically bottom out. Frankly, that's where the framework doesn't have anything to say, because spotting that is beyond difficult. Bonds, again, very binary with respect to rates. If rates are falling, they do well. And when you think about it, both real rates go down because we have lower growth and we have lower inflation. So both real rates and inflation expectations are reduced. Commodities, indistinctly of what happens to rates, do badly in phase 4. Now, all this stuff with the output gap is also good, but you might wonder if we can measure potential GDP. There are a lot of issues here. But I think the key point to notice is that we have proxies. We don't need just one estimate of the potential GDP so that we can calculate the output gap. We can use other measures. At the end of the day, a lot of this is about monitoring the economy. So one measure is the unemployment rate minus the natural rate of unemployment. So if we're below what is considered the natural rate, we're probably in a positive output gap. Resource allocation is another measure. We can use the index for capacity utilization, and then we can combine that with a similar measure for the labor market, namely taking 100 and subtracting the unemployment rate. It's sort of a capacity utilization for labor. And finally, the slope of the yield curve actually says something about the output gap. Here are some graphs on the different measures compared to the measures of the output gap. As you can see, they get pretty close. So where are we now? I would say we're in phase 2. We've eliminated the output gap, the negative output gap, and we're now beginning to create a positive output gap. The longer we do that, the longer our economy, and this I'm talking mostly about the US economy, the longer the economy grows at a higher rate than the potential GDP, the deeper we will get into a phase two. So what questions are relevant in a phase two? Well, are we going to see a pickup in inflation? And if so, how is that pickup going to happen? Will the Fed continue to tighten into 2019? And if the whole thing ends in a recession, which you might think, because a phase three and a phase four are typically consistent with recessions, how close are we to this? So let's have a look at these things. I don't know if you can see this graph very well, but it has hourly earnings, which is an expression of wage growth in the upper line, and the lower line is the core inflation measured by the personal consumption expenditures index. That's the target. That's the inflation measure that the Fed prefers, and the target is 2%. So that's where we are right now. So we can have two scenarios going forward. Inflation picks up. Inflation, as understood by the measure of the Fed, starts picking up, and this Fed tightens more than we've expected in the markets. Then multiples are more likely to contract, and of course bonds will not do well. Or alternatively, wage growth outstrips growth in the PCE inflation index. If that happens, then profit margins will be squeezed. What about the Fed? How is the Fed relating its policy to the output gap? Well, the intriguing thing is it does actually look at this. There's no doubt about this, because look at this chart. We've typically tracked changes in the output gap, even though there's been a delay in various periods. And indeed, the latest period we've seen since 2009 has seen the latest delay, the longest delay we've ever seen. Why did the Fed take so long to normalize policy? Well, presumably because there were still fears of deflation, the banking sector was still fragile, etc., etc. But now the Fed is hiking rates. It's very clear. And the recent statement we got yesterday was that the committee is pretty much in unison in thinking that more tightening is necessary. Does that make the Fed crazy or loco, as we say here in Spain? I don't think so. It's preemptive. It's a natural thing to adjust monetary policy and normalize it as the output gap has diminished and now has become positive, or at least is moving into positive territory. So this brings us to the next subject, the risk of inflation, the risk of recession. When the Fed tightens, we typically see longer dated yields, shorter dated yields go up by more than long dated yields. So when that happens, the slope of the yield curve, which is the same as the spread between long dated bond yields and short dated bond yields, tends to go down. And that is indeed what we've seen. So if you can see this, what we have on the left scale here is the slope of the yield curve. And on the right scale, we have the Fed funds rate where the scale is inverted. So as we move down here, Fed gets tighter and the yield curve gets flatter. If it gets flatter and flatter, it might eventually invert, in the sense then that long-dated bond yields would be lower than short-dated bond yields. That has traditionally been a good indicator for recessions. In this chart, the shaded areas are recessions, and as you can see, they've practically always been preceded by a negative slope of the yield curve, or an inverted yield curve. So does that mean that recession is just around the corner? I don't think so. I would note two things. Firstly, the Fed is normalizing policy, but it's not doing it at very high speed. Maybe it'll take a break, by the way. And another thing is, if you look at the chart, you can see that the inverted yield curve does indeed predict recessions, but it does that somewhat prematurely. So add up the two factors. Maybe we have to look at 2000 and 2020 before any such ideas become relevant. Summing up on the current scenario, it does look like we will see earnings continue relatively strong, but we'll see more Fed tightening and we'll see multiples contracting. So that does look like for the next year or two, if you have a tactical view, single-digit returns on stocks are more likely. Adding to this, and this is not something that we can see in the model, of course, if we get a fully fledged trade war with China, this could accelerate the inflation. If that happens, then we get a shorter phase two. So we need to keep an eye on that. Government bonds don't really work as a hedge in this part of the phase two. Why not? Because arguably some of the problems actually come from the bond market. They're subject to the same headwinds as stocks. They will work if we get an recession, but it's probably too early to worry about this. However, commodities do work right now as an inflation hedge. So let me summarize these ideas. Warren Buffett famously said that his time horizon, his preferred time horizon, is forever. All respect for Warren Buffett. He's an amazing investor. But I think the rest of us mortals cannot do this. It's too long a time horizon. Drivers of return are very different between the strategic level and the tactical level. Valuations are not, frankly, very useful for detecting turning points. And I'm saying this because a lot of people say, well, the stock market's going to do badly. Look at how expensive it's got. Interesting. If it changes, if we get to a turning point, the stock market starts going down, then of course the fact that stocks are expensive will probably accelerate that. But it doesn't help us to spot that turning point. But the business cycle has a much better chance of doing that. So the SAA sets our route to future returns, but we need to remedy some of the weaknesses that it has through TAA adjustment. How much do we need to forecast for the TAA? See, a lot of people think that anything which is short-term, including tactical asset allocation, requires forecasting. I don't agree with that. I think we can actually arguably call this nowcasting. We have to know whether we are still in the same phase or we've moved to a different phase, but we can assess that on incoming information. We can then use the idea of a transition to a new phase as part of our risk management. So take into consideration before we even start what would happen if we transition to a new phase. And finally, we need to exercise judgment and common sense. There's no perfect framework. Thank you so much. I'll take your questions.
Okay, great. Thank you so much, Henrik, for a very thorough presentation thus far. And to the audience, so I did send a prompt asking for your questions, and this will be a great time to start sending them in, and we'll take as many as we can and go from there. This first question comes in from Ravi. Ravi, I'd like to understand your opinion. Does the different business cycle phases in each economy present a diversification of opportunity with regard to asset allocation in a global investment portfolio?
I think it does indeed, but I think there is a limitation, unfortunately, and it comes back to what we talked about previously with portfolio theory. There's contagion between the markets. Markets tend to correlate. So the funny thing is, if you look at Europe, for example, Europe has been vastly underperforming the US stock market in recent years, or at least recently in the past year. So you might say, well, that's sort of a decoupling. Yeah, but if the US market turns around and starts going negative, will Europe then be able to detach itself from that? I don't really think so. But that doesn't mean that correlations are perfect. So sure, there's always a case for spreading risk. I don't think we should contradict the idea of portfolio theory, but we should just be realistic about it. Contagion happens as well. So for the long part of our portfolio, if you say the SAA, does it make sense to be invested in more than one market? Absolutely.
Okay, great. Our next question comes in from Doug, and he wants us to shift briefly to the United States context. And he'd like to know if you see there being less willingness to invest given the current administration's rocky or tenuous relationship with the Fed.
I don't think that's necessarily the case, but I think markets get a little bit nervous when we hear the president starting to criticize the Fed, because it's tradition in the US and elsewhere that the Fed is independent. And of course, it doesn't change its independence, but it does sound like the president might like to influence his decisions. So if I were the president, I would not do this. I don't think it's necessarily to the benefit of him, even politically. The markets do get somewhat nervous, but I think we'll see the evidence that of the Fed being independent over the next years. I don't think it's going to get tighter because the president says that it's going too tight. I don't think it's going to sort of prove its independence, but I think we'll just see its independence manifest in what it does.
Thank you. This next question comes in from Gary. He'd like to know which stock sector is likely to outperform in this stage of the cycle.
Generally, without going very specific, I would be somewhat more passive now. I would be somewhat more defensive. There's a better word. Be more defensive stocks, less growth oriented and more value. And I think that will probably be the case for a while, because we can, of course, in asset allocation, we might say, well, I'm going to have less stocks and more bonds in a scenario like this. But we could also go more defensive in the stock market. And I think that is a better route, and perhaps a little bit less tech, because tech is now very highly valuated and is probably more sensitive to a slowdown.
Thank you. The next question comes in from Nancy, and she'd like to know if, in your opinion, there's any such thing as an asset allocation that is just too diverse.
Well, it depends on how much you can manage, I think. If you look at the very big, for example, the endowments of the universities, the big US universities, they have an incredibly widespread portfolio. And these investors are indeed very long-term. And I think they may arguably not meet my framework, frankly, because they can take a very long point of view, maybe upwards of 30 years, because they don't need to have access to all the capital right away. And there it does make sense. And then you really should be looking for deep value. But for most other investors, remember transaction costs. It gets too expensive. We can see the textbooks in finance always show that if you include more than, say, 30 stocks in a portfolio, you've pretty much exhausted the diversification effect, in the sense that what is left then is the systematic risk. So you've eliminated the idiosyncratic risk, but there is systematic risk left. And I think the same happens in the real world. It's a good illustration because we can only get so much out of diversification. It's become an integrated world. But that doesn't mean that we shouldn't have a certain amount of element. I think it's very much down to the size of your portfolio, and it's also down to your time horizon. Another thing, for example, to mention, if you are very long-term, illiquid investments make a lot of sense. You don't need the liquidity and you get rewarded for it. A whole area which I haven't talked about here, but which is covered in my book, is factor investing, which is very interesting, where there you can lock in premium for the long term. And I think there's a lot of sense in that. And there are some interesting vehicles where you can do that.
Thank you. And we'll take the last, actually, there's two more questions. This is from Tiago. Tiago would like to know, building on the point about the US versus the rest of the world equity markets divergence, he would like to know if you see stage 3 starting first on the East and then later reaching the US.
I don't think it'll reach the US in the sense that the US will be dragged into a phase 3 from other countries. I think the US is sufficiently sort of closed as an economy. China is slowing, there's no doubt about that, even though the figures are a little bit debatable. They don't say it very clearly, but I think the emerging markets as a whole are clearly suffering at the moment, and arguably in a phase 3. This will arrive to the United States and will arrive to Europe, but I don't think it's necessarily a contagion, frankly. It's probably still the case that there's more contagion coming from the developed countries going towards the emerging markets than the other way around. Having said that, we do need to look at China. China is the second largest economy in the world now. But the thing is that financially, the financial effects from China towards the US, for example, are not that great. The trade effects are more important.
Okay, great. And this will be the last question coming from Ivan. And Ivan would like to know, what are your thoughts on the longevity of commodities in a portfolio from a peak to a recession situation?
Ooh, That's a tricky one. I think commodities are sort of mid-cycle and late-cycle assets. That's when you want to hold commodities. So there is a case for holding commodities right now, absolutely. And in fact, even in a phase 3, commodities have been shown to hold up quite well. This is what our study showed, which is I based this speech on. But be careful when you get beyond that. In phase 4, they typically do very badly. So it's a commodities from a long-term point of view haven't done all that well, but they have a role in our portfolio from a hedge point of view, and they can hedge inflation quite well. So it's a bit like sort of a somewhat underperforming asset. It's a bit like gold in a way. It's also an underperforming asset from the long-term point of view, but sometimes useful from a hedge point of view. So I would look at commodities, if you look at them from an asset allocation point of view, as an element you'll have in your portfolio, not so much because of its return, but because of its low correlation with the other assets, and specifically because of its ability to hedge inflation.
Okay, great. Thank you so much. That was the final question. We really do appreciate just a very thorough presentation, very detailed and very dynamic on the responses to questions that came in. We thank you to all of you who joined us today for this presentation, this collaboration between IE Business School and Ivy Exec. Please do continue to watch out for upcoming webinars. And with that, we appreciate your time, your presence, and hope to continue supporting you in future. And Henrik, any final words for the audience before we part ways?
Thank you so much for listening. It's been a pleasure.
Okay, great there. Take care, everyone, and see you soon.